There has been a rapid fall on Wall Street where many companies and their stocks crashed. Many big companies have hit choppy waters on Wall Street as stock prices have been falling. Hello, and welcome to the channel. Today, we're going to break down the recent stock market crash and what you can do to protect yourself. There is a prevalent phenomenon where the investors are holding on to one of the most cash in the last 21 years. More issues can be predicted for the ones whose money is in the stock market. In June, we're going to see a rate hike which might cause some problems for investors. The administration, too, is looking to disrupt the growth in inflation and will not worry about the consequences to the market such moves will cause in due time. U.S. indexes have been suffering ever since the announcement that the Federal Reserve will begin to reduce its monthly purchases of bonds. Some experts claim that stocks will fall by 45 to even 75%. It is a reaction to the announcement by the Federal Reserve that there will be an increase in interest rates until inflation starts to slow down. This has now obviously shifted the demand from retailers in the market. There has been a bottlenecked supply chain, which has reduced the goods in the inventory of these retailers, causing the rise in prices due to low supply and high demand. Companies looking at a high-demand market will look to secure the goods to satisfy the demand and place large orders to get in raw materials or finished goods. This is exactly when the Federal Reserve came up with the announcement of rising interest rates, with a hint of raising them even further. It scared the companies and made them foretell a decreased demand in the market, as loans and cash in the market will reduce. Hence, when the companies are now left with too much inventory in their wares and no one looking to buy these products or not enough to keep the goods flowing, demand started to slow down, and now the interest rate rising has only helped it plummet at a rapid rate. There are chances that this may lead to a concept of economics called stagflation. It is a scenario where there is a low employment and high inflation and the overall growth also falls. Jim Cramer has given us 7 factors that need to be brought under control by the Federal Reserve to handle this crisis. These are: Number 1, housing. Number 2, automobiles. Number 3, labor. Number 4, Russian invasion of Ukraine. Number 5, high freight costs. Number 6, airfares. And number 7, consumer savings glut. Housing prices are reduced now in the recent past. The customers looking to get mortgages are also less in the market by 12%. There have been lesser cars that are manufactured during the pandemic, causing prices to increase. The retraction of the pandemic will help more cars to be sent into the market. There were concerns that the wage price spiral can now be dismissed, as wages have dropped. Wage price spiral is where workers pay a certain price for products. When it rises, the employees pay even more, and that raises the price even more due to demand. Russian-Ukraine war is causing gas from Russia and grain from Ukraine less in the market. Hence, these have pushed inflation even more. Freight costs are finally burdened upon the consumers, causing the rise in general prices. There is less travel, which will cause less spending on products. Rising prices will reduce the outlook of consumers to buy more products. Number 1, know your portfolio. A fear-driven reaction to a slump isn't a good reason to dump an investment. Reconsider and reread your original stock research notes. You may find some good reasons to sell. When you research a stock, you must have a written record of the strengths, weaknesses, and purpose of every investment in your portfolio, as well as things that would earn each investment a place in the out box. Your research is like an investing roadmap, a tangible reminder of the things that make a stock worth holding. During a market downturn, this document can prevent you from tossing a perfectly good long-term investment from your portfolio just because it had a bad day. On the flip side, it also provides clear-headed reasons to part ways with the stock. Ideally, before diving into stocks, you should have gauged your risk tolerance or how much volatility you're willing to stomach in exchange for higher potential returns. Investing in the stock market is inherently risky, but what makes for winning long-term returns is the ability to ride out the unpleasantness and remain invested for the eventual recovery, which, historically speaking, is always on the horizon. If you skip this step and are now wondering how aligned your investments are to your temperament, that's okay. Measuring your actual reactions during market agita will provide valuable data for the future. Just keep in mind that your answers may be biased based on the market's most recent activity. Number 2. Trust in diversification. When a market decline hits, your results may vary, and perhaps for the better, if you've invested money across different basket of assets classes like stocks and bonds. Diversifying or distributing your money across investments is key to reducing investment risk and smoothing the ride through a choppy market condition. Diversifying helps ensure your investments, like eggs, aren't concentrated in one type of asset, like basket. So if one stock or industry had a bad period, your other investments may help offset those losses, or at least some kind of stocks may do better than the others in the bad market. Number 3. Be ready to buy the dip. Market crashes can also be a buying opportunity. It is simple as buying stocks on a sale when the market crashes and the prices are unbelievably low. The trick is to be ready for the fall and willing to commit some cash to snap up investments whose prices are dropping. What do you need for such purchases? First, you need to set up an emergency fund. You've allocated money for retirement and you have cash available for everyday expenses. You've set aside some cash so you're ready for a flash sale when a disaster strikes. And you keep a running wish list of individual stocks you would like to own. If you do buy the dip, you probably won't catch the stock at its low, but that's fine. The point is to be opportunistic on investment you think have good long-term potential. Chances are you may freeze in place during the moment of opportunity. One strategy to overcome the fear of bad timing is to dollar cost average your way into the investment. Dollar cost averaging smooths out your purchase price over time and puts your money to work when other investors are huddled on the sidelines or headed for the exits. Dollar cost averaging, or DCA, is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset to reduce impact of volatility on the overall purchase. The purchases occur regardless of the asset's price and at regular intervals. Number 4. Get a second opinion. Being an investor is rewarding when the stock markets are on a tear and your portfolio is going up in value. There are always times that get tough, and self-doubt and ill-advised tactics can take root. Even the most confident saver investor can fall victim to harmful short-term thinking. Don't let self-doubt sabotage your financial plans. Consider hiring a financial advisor to kick the tires on your portfolio and provide an independent perspective on your financial plan. It's not uncommon for financial planners to have their financial planners on their payroll for the same reason. A bonus is knowing there's someone to call to talk to you through the tough times. Number 5. Focus on the long term. When the stock market declines, it can be difficult to watch your portfolio value shrink and do nothing about it. It can be especially hard to watch your portfolio shrink in a year when you might have had difficulties earning during the pandemic. It's normal to feel pessimistic after a crash, but if you're investing for the long term, doing nothing is often the best course. It is important to remember that when you sell investments in a downturn, you lock in your losses. There is always a chance that the market will improve and go back to normalcy. You don't want to panic and let go of an investment, which may in the long term give you what you want. Number 6. Take advantage where you can. Watching your carefully curated portfolio take some unpleasant dips can be painful, but making moves for future you could help offset some of that discomfort. Financial planners often point out that market declines can be good timing for Roth conversions. Investors can take stock of the depreciated assets in their traditional IRA and transfer some of that money into a Roth IRA. Once the market begins to recover, you can happily watch those migrated assets go tax-free. It's important to note that Roth conversions may not make sense for everyone though. One concern is that they often trigger additional taxes since the transfer creates ordinary income. Talking to a tax professional can help clarify if the move makes sense for you. There you go, folks. There are the things that you need to look at when you are wading the waters of an uncertain and stormy market. If you feel like these suggestions were what you were looking for, like the video and subscribe to the channel to get to show us some love. Press the bell icon to get our videos as soon as we put them up.